Hi, good morning and good afternoon. Thanks for joining us. I'm Roy Zimmerhansl, and welcome to our first Securities Lending Live with Pierpoint. So thanks for joining my partners and I, and they'll introduce themselves in a minute. This is the final month of a crazy year. So it's been a year of peaks and troughs, stock market highs, and a market crash. Huge M&A deals, active capital markets deals, and extended dead periods for both of those. And our next podcast guest talks a little bit about what's been happening in the deals in the market. But mostly, obviously, it's been about pandemic and working from home. For those in England, the lockdown has ended and the gyms are open. So if you're like me, you can get back to the iron and relieve yourself of some of 2020's frustrations. As I said, I'm Roy Zimmerhansl. I'm practice lead at Pierpoint. And what we're going to be doing is each Wednesday at this time, we're going to be talking about topical issues and live Q&A. So I'll be doing that with my partners, but we will be having guests joining us as well. So I'm going to hand over to the guests. But first of all, can I just ask you to type in yourselves, where are you joining us from, whether that's live or whether you are watching it on the replay, which is just as important. We're interested in seeing where you are watching from. So if I can hand over to Jeroen, over to you.
Morning, Roy, and luckily in Holland the gyms were never closed, so I have plenty of gym time in my free time. What I could do. Hi everyone. Those of you who don't know me, I am Jeroen Bakker, and I'm the Benelux lead for Pierpoint. 20 years of experience in the securities finance world, and not as much as the other two gentlemen, but definitely I think quite a few years. John, if you mind.
Yes, and it shows you look much younger than both of us. Morning, practice leader Pierpoint. I've been doing this for 30 years now, and this year, interestingly enough, I've learned more around the subject than I had ever thought I could actually possibly know, which has actually kept my interest very, very high.
Yeah, thanks, John. So, Jude, what have you been doing with your lockdown time?
So apart from not going to the gym, I would say one of the things that's quite interesting is when you can't engage or can't engage as much as you can with some of your prospects and some of your clients. You have to find other ways to engage them. And one of the things that we've done here at Pierpoint is writing blogs. Well, that was something I've never done before. I've never written articles. I've never done anything like writing those kind of things. So brushing up on that skills and finding a way to engage the audience in interesting topics, and hopefully they read them. So writing blogs I've been doing.
Yeah, that's funny. I remember talking to you when you joined, and for those of you that aren't aware, what we actually do is we rotate the blogs sort of on a weekly basis between the three of us. And when Jeroen first joined us, he said, "Yeah, but I don't really want to be writing any blogs." Yeah, the funniest thing is Jeroen's always done his first, and they're always really fast because they're a different angle, right, John?
Yeah, I mean, I found, interesting enough, the blogs I quite enjoy doing, although they do take some thinking because we don't exhaust subjects, but we're trying to do something a little bit an opinion based, which perhaps in our previous corporate lives wasn't always that easy to do. The thing I found most about this year is, I live alone, so the lack of human contact at some point, certainly in the early days of the lockdown, was quite a sort of a low grade anxiety. On the other hand, though, the contrast to that is that I've never had more sleep in my life. I think in the last 30 years of working in the city, I've never had as much sleep. And I used to commute. My train was at 6:18 in the morning because I lived past Winchester. And that routine of having a better routine in terms of that, and also actually reading a lot. For those of you who get my daily daily news updates, reading around every subject is actually quite interesting. And the thing that I've really got into, and it's a rabbit hole you can never come out of, is the whole subject around ESG. It's absolutely fascinating, and it never ends. So
Yeah, it never really ends, John, because it's really only just beginning, isn't it? So,
well, it's a journey, and it's a long one, and it's really you're right, Roy. Despite the fact that there's so much around it, it's still very much kind of infancy as to how it's really going to play out.
Right. Yeah, absolutely. So, look, for me, just before I tell you what I've been doing with my spare time, I just want to welcome Zaf from London, Lee, who's from home, but we're not certain where home is from, Manos, who's joining us from Edinburgh, and Femi, who's also joining us from London. So thanks very much for signing on with that. Look, for me, this is a great example of the kind of thing that I've been spending my time doing. It's like really geeky things. So, I spent a lot of time getting coaching on LinkedIn stuff. So that's why I'm probably annoyingly present on LinkedIn for most of you, but also the podcast, which we started in June. That was something we decided to do at Christmas, and finally, after all the lockdown turmoil, we got to it in June, and I love doing them. I think tomorrow we release our 21st podcast, so that's been a lot of fun. And this, like the live stream, I think is really a great way to reach out to a wide community of people. There's not always conferences that we can attend. And this year we had a lot of free ones. Let's see how many free ones sort of extend into the future and what the changes are there. But we thought it'd be a good opportunity for people to have a chance to talk about topical issues and ask questions without necessarily being sort of directed into subjects that the conference organizers and sponsors want you to see. So hopefully this will up the communication. So every week on Wednesday, who knows what my next technical geeky thing will be, but there you go. So Lee, thanks for clarifying. So Lee's joining us from Kent, and I think it's our first overseas person that's
Hey, Roy, come on.
From Rotterdam. I said guest.
Yeah.
You're part of the working team, Jerome. So
good to you joining us, Mike.
Mike.
So feel free to ask questions. Just drop them into the chat. We'll pick them up. So questions, but also comments. We're interested. We'll be talking about a number of topics, and then we'll be dealing with some residual questions. We did our launch of what the firm was last Tuesday. We did an introductory session, and we didn't get a chance to answer all of the questions that were asked then. We're going to address some of them now, and then hopefully the people in the audience, all of you, if you have questions that you want us to talk about, feel free to drop them in. So look, John, first I want to ask you to talk a little bit about something I know that's been important to you is the whole issue around LEIs, so legal entity identifiers. Maybe you can talk to us about where that is now.
Yeah, it's a good question, actually, because there was an article recently in Securities Finance Times which was bemoaning the fact that there are so many ELIs that are allowed to lapse. And I looked into that a little bit further, and it seems to be coming largely from the US. Now, I think in our industry that we all assume that the first time anybody ever sought an LEI was because of SFTR, which of course is not the case. They're used far wider in businesses in general, because to tract in a very transparent way, you need to understand the legal entity, the very specific legal entity you're dealing with. It looks like I didn't appreciate this originally, but it looks like there are a number of reasons why you're trying to construct a transaction. You seek an LEI to do it. The transaction is conducted, and you only need it for a one-off event, and that perhaps is one of the reasons why the LEIs are allowed to lapse. It's quite damning, though, in the sense that, I mean, if that is the case, so be it. But I don't buy that it's the entire reason. It looks like there's almost as many LEIs that are lapsing than there are being renewed, or even an initial first-time LEIs. So where's all this going to go? I mean, if I remember correctly, the SFTR requirements from ESMA were that it was 1 year. Was it 1 year or 6 months to catch up with LEIs? I think it was a year, wasn't it? I probably should know.
I thought it was 6 months, but
so yeah. I think if it was 6 months, that's going to come to a head in February. Look, at what point does this end up translating into the fact that if you can't take collateral, if collateral doesn't have an LEI, you are in a serious position whereby you won't be able to take that collateral. I don't know if ESMA is going to be that heavy-handed, but in reality, it looks like if you read the article from last week, the FCA have made noises about the fact that you must have these things. So it doesn't look great. There's time to catch up, but the reason why firms are letting them lapse is beyond me, because eventually it ends up in a regulatory problem, and that can find, as I mentioned. So we have to watch this space. I don't think that it's necessarily the industry's. It doesn't fall on the industry to encourage investors or companies to seek these things, because I think there's enough work being done on that. So I mean, if I was an agent lender still, I would obviously be having a conversation with all of my clients, but it's not really them I'm concerned about. It's about taking that piece of collateral that's eligible that I have absolutely no relationship with. So if anybody in the audience has any ideas about this, I'd be interested to hear. But there's a lot of work to be done, or more importantly, maybe there needs to be a conversation with ESMA to say that this isn't going well, it's beyond our control, and what are your intentions when February rolls around?
Yeah, and John, isn't the issue a question about sort of motivation for LEIs, right? So an issuer that has an LEI that lets it lapse, I mean, what are the challenges are, what do they care, right? It's actually about the users that are involved with it that actually end up with the problem, right?
Well, but the LEI is such a useful indicator of who you actually are. In any of your dealings, you'd think you'd want this to make an absolutely transparent record of whatever you're doing. So it is odd to me, because again, like I mentioned, I think we think about LEIs only in terms of what we do. It touches every part of the organization's raison d'etre, if you like. And therefore, it's odd that it's lapsing. I mean, if you've gone through a third party to generate it, you get 90, 60, and 30-day reminders that it's about to lapse, and yet they are lapsing. You'd think that compliance would be involved in this, or legal, or a combination of both. But here we are with, I think the report last week was 537,000 LEIs that have lapsed, which is a huge number. So there's something more fundamentally not going well with this. And I think you could argue that we would believe that everyone scrambled to get an LEI for SFTR purposes and then kind of gave up. But that wouldn't be the case, though, because if they were seeking them for the first time because of SFTR, they'd still be live now. So it's those that were obviously more than a year old, which obviously is coming from outside the industry. I don't know whether any trade body wants to get involved in this. I don't know how they would really appeal to issuers globally. I think it really comes from national regulators to make pretty heavy-handed statements about the fact that this is a regulatory requirement, and if it isn't, it damn well ought to be.
Right. Well, I have to say, I recently got an LEI for one of my clients who's launching a new bond. It's the first bond that they've issued, so I had to get an LEI. I have to say, I've not really done many things that were easier and frankly cheaper. So
About $65, right?
Yeah, it's not a workload or a cost issue. So as you say, it must be something else. Anyone in the audience, we're interested if you have some thoughts or ideas or suggestions on that, why that might be the case. So so let's leave LEI for now while we have a chance see if anyone that's actually watching has any thoughts on that. I want to move to one of these residual questions from last week, Jeroen, that I think is really important to quite a lot of people. This year, revenue's down from last year. So one of the questions that was asked is, how can an existing and established securities lending program increase the revenue, and what levers are there to steer and increase profits?
Yeah, well, there was one of the questions that came up on our webinar last week, and of course, it's a very good question. And if you look at profit, you can always look at two different things: at costs and, of course, at revenue. But let's for now focus predominantly on the revenue side. And yeah, if you are an existing lending program, or you're in an existing lending program, and revenues are down, and you're looking at ways to increase it. The question, of course, is how should you do that? And one of the things that first pops into my mind is, of course, is benchmarking. You want to benchmark your program against your peers, and want to slice and dice that in any different any direction that you can, and look at the different asset classes that you're lending, and then investigate whether or not you're above or below your peers. And of course, if you're below your peers, then there is potential. So that's the first thing you should do. You should benchmark your program, look at the different asset classes you're lending, and investigate why you're below your peers. And of course, if you're below your peers, it could be multiple reasons. Of course, one of the things could be that you are not lending your assets to certain borrowers because they're not in your program, or you're not allowed to lend to them, or your risk profile does not allow to lend to them. So that's first of all worth investigating whether or not signing up a new borrower would generate additional income that you might miss out on. Second thing that you want to look at, of course, is your overall collateral schedule. Are certain borrowers not borrowing your stock because your collateral is either too expensive or too difficult to get hold of? Doesn't make a trade worthwhile. So then you have to look internal again and see whether or not you can amend that, whether or not the additional collateral that you could potentially receive falls within your own risk profile. So that's the second point. And one of the third thing that you can have a look at as well is your structure. So of course, in many of the blogs that we and the podcasts that we talked about things outside plain vanilla lending. We're talking about synthetics. Term transactions, all those kind of transactions. Have a look and see whether or not you potentially miss out on certain transactions, and therefore the revenue. So, in a nutshell, benchmark yourself, look at your collateral schedule, look at your borrowers, and overall look at your risk profile.
Yeah, look, I just want to follow up on one of those points with John. So, John, you and I have been talking to beneficial owners since the 90s, and Jeroen maybe also snuck into the 90s there as well. But look, all of those things, frankly, those are all things we talk about all the time. So I want to unpack with the two of you each of those sort of four things Jeroen's talked about. So John, benchmarking. The age-old comment from beneficial owners was, every one of my agents tells me that they outperform the average, and so if everyone outperforms the average, how can you get the average? So I don't know. What are your thoughts on benchmarking? And there's the issue of the ISLA working group that put out some best practices.
I mean, I think it's fair to say that the ISLA working group came about because there are data providers, and I've used a number of them, not all three or four, but I've used three of them, and there are differences in the data, and I think it's fair to say that, look, the data is telling you something, but it's not giving you chapter and verse about this is it, this is how it is. I mean, I've done transactions whereby I've inflated prices because of the nature of the transaction. The actual fee on the transaction was completely away from what you would see in a data provider for a good reason. And yet that still flows into that data, and therefore it's changing the nature of the data. So if someone like Jeroen was comparing me to him, he would say, well, I look like I'm underperforming, but he's not. So I think you need to unpack, as you said, I hate that word actually, Roy, but you need to look through to the data. And that comes from, I think my role as an agent lender was to explain to my clients what they're actually reading. Now, have I been guilty about using the data because I looked at lending HQLA in billions and billions? Yes, because outperforming, because we were 28% of the entire market at the time. I think so back to the group, I haven't really seen any material output from where they are. I did read a press release recently, but if they can get to at least going in, or the input is all of the same nature, and therefore that means making sure that the characteristics of the underlying funds are the same, and that the data you're taking is the same. Are you giving all the data or just what's available to lend? All of those things, I think, have made a lot of progress. But I wouldn't rely on, I think it's useful to have, because without it, you have nothing. And let's face it, this is still an OTC market. And therefore, you have so much discretion in what you're doing. You have to justify why you're doing it. And it's not just to clients, Roy. I've been through internal audits, particularly where they said, yeah, you've lent at this level, but why? So, well, that's where they had to pay the fee. That's not an answer. And they make a good point about that. Now, I'd like to see things move along into a much more rigid format at some point. So that's how I would answer that first point.
But John, on that point, because you're saying we were 28% of the market because we were lending HQLA and probably on term, and well, that is exactly one of the things that if you are not lending that, you are underperforming, and you're seeing that in the numbers. So that's why you say, hey, hang on, what's going on in this market? What am I missing? And I would think that's where, of course, you have to compare apples with apples. But if you do that and you see that you are underperforming because someone else is doing a different trade, that's exactly what you need to know if you think that you're not making as much money as you should.
Absolutely. So, for example, if you only had UCIT clients with a 7-day restriction, which is a regulatory, there's nothing you can do about that. Yet you're not performing in what you're doing. But you can't compare that transaction with a 35-day evergreen, which I think now is probably showing up as that transaction in the data. But when I was doing this, it wasn't. It was just it looked like it was on open, but it really wasn't. So you're absolutely right, Drew. I think you need to look through to what it is you're comparing yourself to.
Yep. And I think one of the things that one of the listeners and the viewers actually mentioned, and that's your cost of collateral. That is so much a hot topic. And you're right. If you are a high rated entity and the cost of doing business with you is less than let's say a lower rated entity, yeah, that immediately will reflect in the fee that borrowers can pay.
Yeah, he makes so I think there's a strong performance from the Kent contingent.
Yeah.
So thanks for joining us, Clive, and that comment was from Lee, and I think some of Lee's comments also go into the borrower side, which I want to explore with you, Jeroen. One of the things you mentioned is, well, look at who you're borrowing from, but it's more complex than that, because you've got sort of the credit rating of that entity, your own internal cost of capital for dealing with that entity and the risk-weighted assets. But also, we found quite a lot of success matching borrowers from their domestic market that could give us domestic collateral that would offset the currency exposures and reduce the risk-weighted assets. So the same GC rate from two different borrowers gave us a different net return on risk-weighted assets. So maybe talk to why you've been on both the borrowing and lending side. So why is this a challenge? Like why not add more borrowers? And if you are a lender, what are your concerns, and why can't more borrowers get onto lists?
Well, I think there were three questions in one go. But let me start with the RWAs, because return on the RWA is of course is important, because it actually goes to the bottom line of the business that you're doing. I have to say that probably not all borrowers will have the ability to calculate their RWA on each transaction. Not only because they probably will not get assigned the RWA on a department or on a desk level, but it will get amalgamated on a high level, and they're not so much penalized for that. One other topic, of course, and that is the old ALD, and hopefully that will the agent lending disclosure. Hopefully that will be a thing of the past soon. At the moment of the transaction, you don't know who you're dealing with if you're dealing with an undisclosed agent lender, and only after the files have been received the next day from that agent lender, you can actually calculate your RWAs. But at that time, the transaction has been done. So those are topics that are more on the RWA. One other question that you raised is like, why can't borrowers come on more list, or why is there maybe still some restriction on that end? And I think that has to do with the with the age-old question about onboarding and getting both lenders and borrowers signed up. It's still a very cumbersome process. Um, I think negotiating an agreement by itself could easily be 6 months. Then you still have to do your KYC. You still have to do your due diligence. You have your credit and your risk assigned, and only at that time you are able to trade. So hopefully there are some things on the horizon that will mitigate that, and I think that's where probably the common domain model will be very interesting to see if that brings some relief on that side.
Yeah, thanks, Dad. We'll come back to that. John, I'm wondering if I can turn to you and a question. Welcome, Sonia. Thanks for joining us. So, John, Sonia's asked a question about beneficial owners really operating under agent contracts as normal, and they have this challenge of looking at collateral and counterparty and flexibility and trying to optimize returns, but also their main priority is sort of their fiduciary responsibility. So how do they balance all of those things? What kind of things have you spoken to people about and ideas?
In some ways, an ideal beneficial owner relationship is one where you don't indemnify them, because that absolutely dictates the control you're going to be able to take. So I've had situations where I think we shouldn't confuse indemnification with choices. It ends up typically being restrictive, because a lot of the thinking sometimes it's expressed as such that if I'm indemnifying you, don't worry about the collateral, which is completely wrong thinking. You own that collateral, its title has passed, and you own it the minute there's a default, and therefore you may end up in a situation you don't want to be in. But the reality is, whilst trying to be flexible, indemnification has a cost to it, and there is so much that the organizer that indemnification is prepared to indemnify, and I think so that does lead to a set of parameters around collateral and what you're prepared to take, and that's where the differentiation between one organization and another. It could be that you're only prepared to indemnify G7. Let's not call it G7 anymore. Let's call it G11 government debt, excluding the UK, because we're a basket case now. But I've had a client once that excluded the UK, and he was in the UK, which told you how much he thought about us. But the trouble with that is you're going to do very little business with the most expensive form of collateral. So I think that beneficial owners will have a risk parameter internally. They will listen to what you have to say and how you're going to generate revenue. And I'm very much talking here about a non-cash scenario, not talking about reinvestment of collateral, cash into collateral. And in that conversation, there is going to be a point where you both agree should be the parameters. The more you can indemnify in taking non-cash collateral, and I'm going through to equities and maybe some more exotic equities, if you're prepared to indemnify it, it can actually lead to the beneficial owner approving an asset class that he doesn't necessarily invest in, indemnifying him. So that's where I've had it the other way, which I've had a client say, look, you can't take this for me, even if you are indemnifying me, because I own it. So when you put all this into the mix, you come out with a reasonable set of parameters. But I can't get away from the fact that if the client is more liberal than you are in its acceptability, they will be constrained by the indemnification, because that's really your risk at the end of the day. And I think a two-tiered approach to that should be, you can indemnify these transactions against this collateral, but not that. And I've yet to come across that in any meaningful way, but I think that was creeping in, certainly before I left my previous employment, that we were thinking along those lines.
Well, I think, John, that's a good point. And the one thing I wanted to just raise before I go back to Jeroen, because one of the comments from the audience, which I'm sorry I can't see your name in this, so apologies for that. But I'm guessing that they're making a comment about being kind of a tier 3 borrower, which means their RWA costs are high. You know, they aren't necessarily the highest volume borrower and things. So that presents its own unique challenges to get onto a lender's list. So I'll come back to you in a minute on that, Jeroen. But look, what John just talked about, I saw a headline. I haven't really had a chance to look into it yet beyond the headline, but it talked about whether securities lending programs can get too bespoke. And I found that really fascinating because from my perspective, if you look at the way the rest of our world is going, and getting back to the technology issue, if you look at when you go onto Amazon and it starts suggesting, you know, which products you might be interested in looking at because of your past records, or you go on to Netflix and it says these are the kinds of programs that you're probably interested in based on your past history. I mean, everything that we do now, even your Siri or whatever device you have that's us listening to what you're doing, and all of a sudden ads pop up on something you talked about for the first time last night, weirdly, that everything is about bespoke, but enabled by technology. So to me, I think it's really strange that we would be even considering that we don't want to make things bespoke. I think customers, in the end, beneficial owners, all the way through to end user borrowers, the whole reason that we're layering over these great technology enhancements that we have is that you can customize and design these things for specifically each individual customer. I had a customer who I was lending international assets for, but not their UK assets, because they wanted to vote everything. I said, well, I can lend that out. You won't get as high a fee, but at least your assets will be in a program. You'll be earning some money. And a borrower that doesn't anticipate going over a record date, or is happy to refinance over that, all of a sudden gets access to cheaper securities, and you have a more liquid market. And while that's not important for the main GC assets, what about mid-cap and small-cap asset managers that are keeping their assets out of programs, making those markets less liquid, that could in theory be enabled by more technology, or a borrower on the other end being very specific on what kind of assets they're interested in borrowing? So to me, I think that's a strange question. I think all of this is about having specific tailoring. It's mass customization delivered through low-touch technology. So I don't know what you guys think about that. And same to the audience, your views, because you're all participants in the market. I'm really passionate about this, in case you haven't noticed. Guys,
yeah, we went all about at the same time, but let me start, because I think you're absolutely right, and I hate these kind of chats where everybody says, well, you're right and you're right, but in this case I do think so, because if you can customize your assets, and it all goes back and look at your inventory, what do I have and what can I lend and what do I want to lend, and if a large program where you are number one of, I don't know, 1,000 doesn't provide that solution for you, I think currently in the tech environment there are solutions out there that will take you one of 1,000 out of it and becomes one of one, and thereby being much more in control of what you lend and what fee you're lending it, and therefore how much revenue you're making.
John, what do you think?
Yeah, I mean, I'd say, look, in some ways we're kind of guilty of this. That you can be, it's your program to run the way you want it, and you can have it any color as long as it's black. And the reason we've done this is because we've come from a very clunky operational structure. We build on it as we grow, and then we find that it's not really fit for purpose, and then we patch it up, and then we end up with these very unwielding systems that we operate under. And anybody wanting to do something slightly different from that, outside the norm, is an outlier, and therefore requires additional attention. A good example is mostly we mark at 102 fixed income and 105 equity. Their client says, no, I want to be 106. Now you've got to mark him completely differently from everybody else. And I don't think we have the technology, Roy, as you allude to, that I think the technology is there, whereby this should not be an issue. At the moment, it's still an issue. And that there's a reluctance to kind of be that flexible. We run massive programs with 200, 300 clients. You don't want 300 individual ways of operating, and you largely won't. There are lots of common features in that, but then you can't really sell yourself as being flexible in the way that the client may want. And there's a marriage between, and if those clients can't find solutions, then they go somewhere else, which I guess there are more bespoke or boutique type of lenders that will actually accommodate this. Trying to do both, though, can run into operational concerns and maybe additional expenses, which is why I think we've at a crossroads between legacy technology and the future, which we are very much obsessed with at the moment.
Yeah, look, so let me just kind of wrap up that. We might come back to it again, but John, while you were talking, what it reminded me of is what things were like in the 90s, and that's what gave rise to some of these specialist agents that started focusing specifically on what clients wanted. So the main entity from that is ESEC Lending and their auction model, but the Goldman Sachs Asset Management used to be, a predecessor firm as well that sprung up to say, look, not everyone fits into, identikit lending programs. Maybe we're there again. John, David Lewis, thanks for joining us. We've had some other people join us and make comments. David Lewis, also from London, and Razor's joined us from the Netherlands. So Netherlands making a strong showing. They're now ahead of Kent in terms of attendees. So we got quite a challenge going on here. But John, David Lewis makes a point going back to the data issue, which says, yeah, look, it's about how granular do you make the data, right? You can narrow things in, but the more narrow that you make your data parameters, the smaller the universe of peer groups. So you end up with a peer group of one. So isn't that a challenge, John, in what you're talking about?
It is if the client in particular wants to be compared to his peer group. But there are clients that don't care, and that you can show them all the data in the world, and they said, that's fine, just talk about my risk. So Dave makes a very good point. For example, if you're a sovereign wealth fund in Algeria, you probably are in a group of one, and there's a very large sovereign wealth fund that would be in its own groups. So I think in general, the fund structures are enough to give it enough of a statistically important enough information to be able to say this is a reasonable way to characterize ourselves. And David makes a very good point. I think, but it depends whether the clients really remember. Most of the information coming out of the want of a better word, the benchmark providers, isn't necessarily always going to the underlying beneficial owners. We may use it as agents, or agents may use it rather, but they use it in other ways. I think they use it actually largely to look at their trading activity and performance. So I'd be wary to think that clients are that obsessed with it. But I do think there are some clients that say, I absolutely do not want to be in this data set for the reasons I just stated.
Yeah. Well, actually, what you're saying is, of course, if you start putting yourself into a lot of restrictions, saying, okay, fine, all of a sudden you are indeed a peer group one. But if you're looking at it from a revenue perspective, and you say, okay, fine, I have a program, I have a main tier European equity, my collateral schedule is G3, G7, whatever it is. At that time, you don't have to go into the nitty-gritty of what kind of beneficiary you are. You are a beneficiary owner that accepts only non-cash collateral and only G7 debt. And I think if you look at that group, there is plenty of data to go around. So I would say the most important thing is that people that access the data can slice and dice it in their preferred their preferred way, and to give them sufficient information to benchmark themselves.
Yeah. So, Drew, and listen, Mike from Rotterdam's actually been talking about kind of the issues related to the risk and compliance, and the turnover, the slow processes, the silo. I mean, there's all kinds of different opportunities that become roadblocks.
Yeah, of course. We're talking in a perfect solution that you have decision power over your entire process flow, which quite often, if you're in a big organization, is not the case, and everybody has to say something about it because they all want to safeguard their own job, and the risk has something to say about it, and credit wants something to say about it, and then all of a sudden, a deal that you think is just money is already out the window because it's too long to go through too many committees. On one hand, understandable, because of course there is a risk involved, and people want to monitor the risk, and people want to safeguard the organization against those risks. But I do think what Mike is referring to is that being agile and being nimble and being quick to react to certain developments in the market, those parties will make the additional revenue that's on the table.
Okay, cool. So we've had, appreciate, we've had a couple of new people join. So when I say people, I am including AI implications, but I'm sorry, Clive, cats don't count. Otherwise, Zafira would be bringing in her cats, and then then we need cat herds, and it just wouldn't really be conducive to an effective program. So, but nice try. Appreciate John joining us from London as well, and Drew from Securities Finance Times. Look, I think the reality is, just like the journals like Securities Finance Times, this is about trying to address the hot topics. That's why we think this is quite a useful forum, and why we invite people to raise some comments. And I think there's been some great ones here. John, there was a question from Clive actually talking about indemnification, right? And I think we've talked about this in one of our recent blog posts. The cost of indemnify. You just say, what's the cost of an indemnification? The answer, like so many other things in securities lending, is it depends. It depends on who's offering it and what the program is. And you kind of indirectly referred to it with the collateral issue.
Yeah, I mean, the answer. Sorry, you didn't. Sorry, go ahead.
No, I was just saying, why is this such an issue? It is not an unreasonable question for a customer to say, what's the cost of the indemnification? And I'll determine.
I think it comes down to the fact you have to really talk to your finance department will set the cost of the indemnification in terms of what it really does cost. In terms of as a contingent liability, it has an allocation of capital to it, but it will depend on what's going into it to come up with that number. And it's a great answer because every single bank will actually price it slightly differently because it is an interpretation of accounting. The best answer I can give you is if you can find, and I've tried to find this and I can't, but I had it once. Glenn Horner at State Street once published the absolute calculation of indemnification costs. It would be and it was on the internet at one point because I remember reading it. And if anybody can find that paper, please circulate it because in that, Glenn gives you the calculation. Now, that isn't going to be the entire answer because one organization will look at it slightly different from a risk point of view. I don't actually think it's that high a cost. It depends on how much you're actually having to indemnify. And you'd think that it's a sort of straight line growth number for the size of your program. I mean, if you're indemnifying a 400 billion outstanding program, that is going to be somewhat different from a more modest one. But I can't give you a straight answer to this because I've worked in a number of organizations and all treated and calculated it differently.
Yeah.
So Glenn could solve it for us.
Yeah, wow. It's like in 2008, the month after Lehman, when we were at a conference, and a couple of agent lenders came up with different calculations, saying our risk people have determined that 105 is not the correct number. Interesting, independently, both risk groups came up with 107. So who knows whether there's magic. I think Lee makes another great point here, where he's talking about, the value of an indemnification also looks at the credit worthiness of the indemnifier, right? There is a difference there, and even the type of indemnification that or backing for that indemnification itself. Is it capital? Is it liquidity lines? Is it insurance policy? So all of these things go into it. So like I think that's. I think we've talked quite a lot about that. I want to talk about a couple of other things, and Reza mentioned it earlier. CDM. So first of all, let me just say to everyone that as the headline now says, or the subtitle now says, this week's event. We've been talking about sort of general issues. Next week, we're going to specifically be focusing on CDM. One of the things that we believe very strongly in at Pierpoint. I'm going to go to Jeroen in a second with a question about sort of the future and costs and alternatives. But look, CDM, I think yesterday was a great event, which probably proved an important concept. The question is, where do we go from there? That's why we've brought on board Julie and Air to work with us and collaborate on this area. We think it's really critical. And next week, we're going to focus on a review of the ISLA showcase and talk about where this market goes from here. Like, was that nice, one and done, and we'll think about it in future, or is there a real pathway to making a real difference? And Drew, I know one of the questions that you wanted to take that was residual from last week was this issue of, in the past, we've always thrown people at securities of finance process to be the solution. But obviously that's not the way the market is anymore. So maybe talk to us a little bit about that.
A few things on that. So going back to the earlier question that we raised here, is that about generating revenue and how can you improve that? Of course, if you are throwing people at your program, and while the program is growing, more and more people you need to do your collateral management, to do your compare to pair, to do your billing, to do everything. Of course, that hurts on the bottom line. So at the moment, there are already sufficient service providers out there that can help you eliminate the additional people that you're throwing against it, whether or not it's on your collateral side or whether or not it's on your billing and your contract compare. On the trading side, there are plenty of electronic trading platforms that can help you increase your profitability. But looking where securities lending is coming from and where it's going, I think that there is still a huge path to go to. Just itself, the agency lending, we discussed the. We briefly discussed the ALD and already the outdated and archaic infrastructure that you have, and as a result, will penalize yourself on your risk profile and your risk calculation, and therefore also on your RWAs. But going forward, and hopefully it's going to be the near future and not the very far future, because I look back and how at my previous company we went from the 1995 of the 1996 Oslo to the 2009 and 2010 GMSLA, and that by itself was already like a huge process that took for ages, and every legal department of every company had to have their say on it, and I think one of the main things that the common domain model will hopefully bring is a standardized agreement, and that by itself would streamline the process already so much. But of course, the big question is, can everybody agree to a format, to a standard?
Yeah, it's one of those things where if you have 4 different standards, what you have is no standard at all. John, I know you spend a lot of time and you've been working on our second white paper, finalizing that. And again, it's this issue of cost and operational efficiency. I don't know if you want to add anything to what Jeroen just said.
Yeah, actually, what I find interesting is that I mentioned as we started that I read a lot about ESG, not just within our industry, because I think that's a separate subject, but in all my reading, the thing that really is absent that investors are looking for is how do they make sense of all the data? Because you're talking about a very subjective approach to investing. You're talking about your principles and what's important to you and reflecting them in the investment decisions you're making, or you're asking your investment managers to reflect that, and investment managers are taking that on board themselves. But it is very subjective, and therefore standardize to get some standardization about the output in terms of how you score companies is difficult to do. And when I'm reading all this, I'm thinking about, as Jeroen pointed out, the lack of maybe standardization in our own industry. And you'd think it'd be relatively simple to all agree on non-contentious issues that we all face, like mark to market every day is a pain in the backside for everybody, because there's always somebody that wants to use the Bloomberg price from last night and you're using a live Bloomberg price this morning or some other price source, and you can't agree. So if we can all agree on things that we don't need to necessarily compete on and look at those first, and I think it has to be in post-trade services is where, or the life cycle of loans first, Roy, where all these things happen every single day is open, then I think that's a starting point. So that tips on that.
Yeah, well, you mentioned ESG again, so maybe so everyone in the audience watching us, just FYI, we've got under 10 minutes to go. So if you have any last sort of questions or comments, get them in now. There's about a 30-second delay from when you type something in and when I can actually see it. And if you see my eyes darting around to the right or to the left, I have various screens around me that are giving me information and feedback and questions and comments and everything. So it's not that I don't love you. I do love every single person watching live and in the replay. But I'm trying to run things here. So if you have questions, get them in now. John, let's get back to ESG. You just kind of touched on it. You touched in your opening remarks as well. ESG. I mean, what an opportunity and a minefield. And I was, your blog post this week talked about ESG. So maybe you can just sort of talk to us a little bit about that.
Yeah, I mean, the post this week was really driven by things I just mentioned, in that it is quite a minefield and it can really be quite full. Reading, everything looks like it's all teddy bears and rainbows, but it really isn't that. There's a lot of dissenting voices that will say this is actually going to lead to underperformance. And I used an example of the fact that there are certain industries which tend to get excluded from investing, but actually are great yielding companies, or great, they pay massive dividends, and they have to, because they're in that box which says, no, they're sort of dirty companies, either coal producers, tobacco producers, etc. And that's understandable. And I think the interesting part comes from, do you invest in a company that's trying to do better, that has set goals? And then the other point is, if you're setting a goal, and by the way, this applies to all banks as well, if you come out with some very lofty ideas about your carbon footprint by 2050, no one's going to take you seriously. If you're saying you're going to reach this goal by 2025, you better be doing that. And therefore, investors are making a distinction between goals that are way too far in the future to what is practical to do now, and are you going to make that? And I think banking it applies to all industries. The industries that are polluters, that are trying to move away from that, I think are ESG compliant, because we can't be naive enough to say we can't invest in all of these companies, because then they'll end up, well, you could argue some of them will go bust, but the reality is that a lot of them won't. And then you'll be tempted to buy them because of the yield. So I think that's why it becomes so subjective in how you approach it, which is why the standardization issue is going to be an issue. So if we talk about securities lending and ESG, I'm very interested in how there's going to have to be some industrial way to do better with the collateral. I know a lot of organizations now are just saying, look, here's some ISINs or some SIC codes. I can't take them. Please apply them. But that seems clunky to me, and I think there has to be a better way of doing it. And we have some ideas on that front if anybody wants to know more. The one thing that's been interesting lately, though, is we talk about voting and how forever, as long as I can remember, you can't manufacture a vote. And I think that's fair to say that no one's ever. I've had clients ask me, and I said, look, I can't guarantee what the borrower's going to do. There's no way of demonstrating that. There's no look through for me. But I was thinking, what kind of votes are we actually wanting to vote on? And I think there was a comment made in one of the recent webinars that actually the huge amount of voting that takes place is really about remuneration and appointment of directors. And if that's really important, fine, we get it. But what is the give up by recalling the stock if it's actually at a high fee? And I wonder if there's an intersection between or recalling X if the fee is Y. Because recalling everything, I think, is absolutely discretion. And I think with principles of ESG becoming much more prolific, we may end up with a recallable market. But then there's also a fiduciary responsibility to maybe, if the revenue for the fund is actually going to outweigh your very tiny 0.001% of the vote, are you doing the right thing by recalling everything? So I'd like to see more on this subject. But it has to go back to the beneficial owners themselves and what they're being driven by, because it would be a shame to interrupt this market permanently. And what would it look like if all stock is recallable? I don't know the answer to that yet.
Yeah, look, Drew has added in the comment about the CFA Institute criticism for the idea of a global standard and sort of the efforts going on in securities lending. Look, my own view on that is this is a global issue. I think that regional variations will continue, but that doesn't mean that we shouldn't be trying to have global standards that people aspire to. But like with any standard, with any rule, with any policy, there is the policy, and then you have an explanation that goes to actually justify your own position within that. And that's that, to me, this is just another example of that kind of customization, where at the end of the day, a pension fund and its pensioners and the fiduciaries that are responsible for it have to have a clear concept, policy, and governance strategy on dealing with all of these issues: lending, not lending, recalling, what they can invest in, what they can take in collateral. And that goes back to my comment earlier about sort of the bespoke nature of it. So the fact that there might be individual interpretations and applications of these rules doesn't take away the value or the need for having global standards. It's just a differentiator. To me, it's like benchmarking data. You have a number and it says 7, and it's not about whether the absolute number is 7. It's like 7, and then you contextualize it within the client and the program that's offered to them. So I think that's really important, John. So all those points that you talk about, I think, are good. I think it's inevitable that ESG will be one of our future topics for this event. So stay tuned for that. We've done 60 blogs. My guess is probably we've done 6 or 7 on the topic of ESG in a year. And so clearly it's kind of top of mind. Look, we're coming up to 2 minutes to go. David, thanks for your question. As I said, we'll be doing another ESG event at one of these Wednesday sessions.
And Roy, can I just say that David's absolutely right on that. And you don't have to wait to vote to engage with a company. In fact, if you're an investor, you ought to be having dialogue with a company throughout the year.
Yeah, and look, but the reason why I think it's a bigger issue is because one of the issues with activist hedge funds is that they're often excluded from engagement with the company. So that in itself is an issue, which is why I think there's many layers to all of these items. So I guess that's probably it from us. Look, next week, next Wednesday at 10 a.m., we'll be talking about CDM. So don't forget to join us there. Don't forget to check out the podcast. I've got loads of these things, and you can find everything at pierpoint.info. So on behalf of Jeroen and John, thank you very much for joining us, and I look forward to seeing you next week. And thanks very much, guys.
Thank you.
Goodbye.
Thank you.